one thing that I guess maybe Fernando will flag as well, but is very important to our ag thesis is that California is proposing limits on fresh, virgin soybean and canola oil in the production of this theoretical green diesel. It's not that green, but for renewable diesel, these are biofuels are incredibly important markets for ag. 40% of corn, 50% of soybeans go to add gasoline. In the case of soybeans, go into renewable diesel and biodiesel, and that is basically what's driven the ag cycle for really 2 decades, right? Increasing amounts of ethanol, and then later increasing amounts of biodiesel and renewable diesel for diesel. And the idea is that this is going to go into sustainable aviation fuel, which isn't really all that sustainable. But one of the things that is coming out here is that if California limits it, there are a number of states that follow California. This wouldn't take effect until 2028, this limit to 20%. Currently it's about 40%, I think, is soybean oil nationally. So this would be, a meaningful potential, I guess, reduction. This is sort of a newer piece of information, so we have some work to go through. But it would be a meaningful, certainly a cap on the potential growth of soybeans going into renewable fuel applications, at least for diesel. Then you'd have to look at sustainable aviation fuel and the impact on that. When you want to think about should I be bullish or bearish ag, penetration of soybeans into diesel is kind of the big issue for the next couple of years. Like if you don't have additional penetration, it's very easy to see how the ag environment would be bearish. You have electric vehicles taking share from ethanol. If you do get additional soybeans into into biofuel applications, it's easier to get a more bullish view of some of the ag and ag manufacturers. So this is the important point, and this is an incremental, I would say, significant bearish data point for the ag complex.
I'll follow up on Jay's from a refining standpoint and the fuel itself, but I think two comments to add to that. First, there's actually also a step down in the credits that you get based on your carbon intensity that will happen faster. So renewable diesel that's made from virgin soybean oil or canola oil will already get a lower credit value than used cooking oil and animal tallow starting in 2025. That's a way that California is trying to find to slow down the drop in their credits, which is a very significant part of the margin for renewable diesel producers. I think overall the message from our end is the incumbents continue to benefit from renewable diesel, especially the ones that have pre-treatment facilities and can source used cooking oil. But the growth there is going to get challenged. Once it starts to either become too difficult for the industry to survive or too expensive for consumers and governments to subsidize, they'll start cutting that incentives. It's the cycle that happens with all these biofuels because they're not good enough to stand on their own.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.